Coming down the home stretch of 2025, let's make sure the IRS only takes what's required and no more. Today, Nikki joins me to talk about a simple playbook of strategies that you can still use this year, plus a few moves that will set you up for the years ahead. Hello, welcome back to Wealth Wednesday. I'm Neil Watson, a CFP Pro, and joining me is my friend and fellow CFP Pro, Nikki Ludy. Nikki, it's good to see you again.
Good to see you too, Neil. And there's still some time for some smart planning before year end.
Right, and let's start with tax loss harvesting. In plain English, if you bought an investment and it's worth less today than what you paid for it, you can sell it to lock in a loss. That loss can reduce taxes on your other gains and sometimes even reduce your regular income.
Correct. So if you own a mutual fund or an ETF and you reinvest dividends, each time that you do that, it raises your cost basis, and then it creates little tax lots for every time that you make an additional purchase. And if those are below what you originally paid, then you can sell those and realize those tax losses, which can accumulate onto your tax return.
Right. And sometimes those investments aren't even worth less than what your original investment is. Here's some simple rules here. Remember that losses offset gains first. Then you can deduct up to $3,000 of any leftover net losses to reduce your other income. Anything that you haven't used this year gets carried forward into future years.
Right. And there's something to be mindful of called the wash sale rule. So what you can't do or what disallows the loss is if you sell a security and buy the exact same thing back, you need to wait at least 30 days. So sometimes what is helpful is if you sell a position, you can purchase something that's similar, but it can't be exact. And that will allow you to recognize the loss.
Right. And that plays into something that we've been using more and more for future planning, and that is something called direct indexing. The tax loss harvesting is a current year tax lever, but you can apply the same idea to longer term goals.
Right. So the direct indexing is just on a bigger scale, and it systematically uses market ups and downs and buying and selling individual stocks to realize these losses, but then it's still keeping you invested.
Right. It's not designed to make your account go down. The goal is to grow the value over time while capturing the losses from that volatility that can reduce your potential income tax going forward.
Right. So, just for a simple example, the program might buy Coca-Cola, for instance. If Coke then drops in price, it can sell it, recognize the loss, but then the proceeds can go in to purchase a similar stock, maybe like Pepsi, which would be in the same peer group.
Yeah, over time, you can accumulate losses that carry forward into future years.
Right. And typically we would consider something like this for account sizes around $250,000 or more. Again, this is all non-qualified money that can do this, so IRAs don't apply. But there can be additional fees. So you have to make sure when you're looking at something like this that you understand that there can be tracking error, that because we're going in and buying and selling, that it's not necessarily always going to completely follow the index. But then also that your tax benefits justify the fees that you're paying to be in a program like this.
Right, that's great context, and this is an especially good tool if you anticipate selling an appreciated asset in the future, like a business or even potentially a real estate investment. The next play on our playbook is Qualified Charitable Distributions. We talked about these a couple of weeks ago, but what are some simple rules that people need to know here?
So if you're 70 and a half or older and hold an IRA account, you're able to take distributions from your IRA and have them go directly to a charity. In turn, you don't have to report that income.
That can be cleaner than donating cash, especially if you don't itemize. It can also help with income-tied thresholds for things like IRMA and switching tax brackets as well.
Right. You don't have to itemize to use this kind of tool for your taxes, and there are no thresholds that you have to exceed. One of the keys, though, to doing this is you do have to have your IRA custodian pay the check directly to the charity. So you don't want to take the distribution and then try to turn around and direct it to charity from there. You want to make the check payable directly to whatever charity you're giving it to. Our
next play, bump up the deferrals on your last few paychecks before December 31st.
Yes, absolutely. They give you, if you're 50 and older, you can do catch-up contributions that are above the normal retirement plan limits. And if you're between the ages of 60 and 63, your many plans now are offering what they're calling a super catch-up. And this is the greater of either $10,000 or 150% of the standard catch-up. So if your plan adopted this, this is a way for you to defer additional dollars before year end.
Right. And here's some ideas for you. If you're expecting a bonus at the end of the year, ask your payroll department if you can defer part or all of it. If you get a raise, immediately raise your contribution percentage. So some of those higher pay dollars go into your savings as well.
Bottom line is you want to make sure that your plan allows these items, and you always want to target your match first. So if you get a match up to 4% of your deferrals, you want to make sure you're doing at least 4% or more, and then layer these catch-up contributions on top of that.
And so while we're on this topic, here's a heads up for future years. Beware of the mandatory Roth catch-ups that are coming. You don't want it to be a surprise.
Right. If you're a higher income earner, which is defined as more than $145,000 a year, the rules state that going forward, your catch-up contributions will be Roth contributions, aka you will pay tax on those. But then the Roth account allows for tax-free growth going forward in retirement.
Yeah, and can be a blessing in disguise, really. Someone is going to be taxed on those pre-tax dollars that you've contributed over time, either you or your kids. The Roth, there's a real possibility that growth will never be taxed.
Right. This can be a good thing. So there may be a little bit of tax bite on initially up front, but then that tax-free growth, in turn, Roth accounts don't have required minimum distributions for the account owner, which can be a benefit. And then also, if someone inherits this money, this is all tax-free whenever the distributions are forced to come out.
Our next strategy comes to itemizing tax deductions. The One Big Beautiful Bill changed some rules this year, and you may be a lot closer to itemizing your tax deductions starting this year.
Right. So if you add up your mortgage interest, state and local taxes, which is subject to a cap limit, and then your charitable gifts, if you're nearing the itemizing threshold, you can consider bunching these deductions going forward to push you over the limit.
And by bunching, here's what we mean. Maybe you're planning to give $5,000 a year to a charity for the next 3 years. If your cash flow situation allows, consider giving $10,000 or maybe even all $15,000 this year.
Right. Stacking those up can, potentially push you over the limit, so you can exceed it and get a bigger bang for your buck in the year that you do this and bunch them all together.
Yeah, and next year, even if you don't itemize, households are going to get a small benefit for giving cash to qualified public charities. $2,000 above the line deductions for married couples and $1,000 for single filers. It's a simple way for standard deduction households to still get a tax benefit for giving.
Right. And some details to remember around these. These are for cash gifts only. And, they have to go to qualified charities, not to a donor advised fund. So, all of this equates into, you need to know your timing of all of this. Bunching may help this year, and the above the line benefit may help you next year.
Right. So a quick recap: harvest losses, avoid your wash sales, stay invested. Direct indexing is something going forward that can help systemize loss harvesting, maximize those contributions when you can and cash flow allows. And then if you're close to itemizing, bunch those gifts and remember next year's above the line cash gift.
Right. And if any of you want help tailoring to your specific situation, we're here to help with planning for this and helping you understand what lies ahead with the tax rules.
All right. Thanks for watching today. If you liked what you saw, please hit that like button and subscribe to our channel. You can also find out more about us at cfswv.com. Thanks for watching. Have a good week.